Imagine walking into a grocery store and trying to buy one of everything. One apple, one loaf of bread, one of every single item on every single shelf. Well, number one, you'd be there all day. You'd certainly be broke by aisle three. But now imagine instead you could buy a tiny slice of the whole store in one simple transaction. And oh, by the way, hire someone to keep the shelves stocked just for you. Well, that's a very simple way to describe what is known as a mutual fund, or our word for today here in episode 19 of our financial jargon series. A mutual fund pools money from a lot of different investors and uses that money to buy a big basket of investments, often hundreds of stocks or bonds, all managed by a professional. When you buy one share of the fund, you own a sliver of everything inside it. It's a potluck. Everyone throws money in one pot. A pro does the cooking, and essentially you all share the meal. Now that's enough of my my grocery analogy, metaphor, what have you, right? The catch is that in this instance, the cook or the money management firm charges you for that privilege. Now, here's how a genuine Wall Street professional in Wall Street speak might describe what a mutual fund is. A mutual fund is a pooled investment vehicle that aggregates capital from multiple shareholders to purchase a professionally managed, diversified portfolio of securities, priced once daily at its net asset value. Right. Well, if anybody talks like that, either when you're in their office, God forbid, or if you're at a gathering, then please, you have my permission to just say, stop. I don't want to hear it, right? So said another way is we pool our money with other investors. And now that we have a larger pool of money, we're able to buy not just one stock, but many, many stocks, or not just one bond, but many, many different bonds. So we get diversification. We get one big basket of stuff, and everybody owns a little slice of the mutual fund. You own shares in a mutual fund, and the mutual fund owns many, many, many things based on what its bylaws or prospectus says it's supposed to own. Now, I know a lot of people think that if they own a large cap growth mutual fund, that, hey, that mutual fund manager will go to cash when he thinks the stock market is looking a little tired. But no, by law, by mandate, by the prospectus of that mutual fund manager will always be and always stay invested in those large capitalization growth companies. That's what his job is. It's not his job to time the market. If you don't want to own large cap growth stocks, you need to sell that mutual fund. It's very simple. Okay. Now, a mutual fund has three layers. Layer one is that basket, that multitude of things. Remember, instead of one stock or one bond, you get hundreds in a single purchase. That's the instant diversification. Now, remember, careful here now. Diversification in a mutual fund doesn't mean necessarily that you got lots of different stuff. It means you have a lot of the same stuff. Okay? A lot of the same. For example, if it's a large capitalization growth mutual fund, you're going to own all large capitalization growth stocks. They tend to behave together. You don't have the risk of having everything in one stock. You might have 100 different stocks, but you still own all of the same sector or all of the same class. Okay. So the don't put all your eggs in one basket idea from episode 13, diversification, is sort of done for you automatically, but it's not diversification across different asset classes or different tax treatments. It's diversification across multiple different positions, but they are typically very similar. Okay, layer two is we have a professional money manager, and that's the person who ultimately decides what is going to go into that basket and what and when those things should be taken out of the basket. So you are hiring expertise so you don't have to track hundreds of different companies all by yourself. Now, layer 3, and perhaps the most controversial, is that management, that professional management, does not come free. Every fund charges a fee called the expense ratio. Now, it sounds small, but it comes out every single year. In fact, it comes out a tiny little bit every single day from the net asset value of that mutual fund. Whether it's a good market or a bad market and the fund is losing money, the fee is still charged. Now, there's other costs associated with mutual funds. I don't want to get too deep in the weeds here, but the expense ratio is typically not the only expense involved in owning a mutual fund. Okay, so to sum up, a mutual fund buys you diversification and a professional money manager. Just make sure you know what the manager costs. So here's the question I want you to sit with today. Do you actually know what the funds inside your retirement account, your IRA, your 401k, do you know what they're charging you every single year? Has anybody ever shown you where to look for those, not just expense ratio, but all the costs? Tell me in the comments if you think you have an idea. Now, a mutual fund can be a wonderful, simple tool as long as you can see what's inside it and what it costs. Now, I know from being in this industry for almost 30 years that a mutual fund is typically a very expensive way to invest, and it's also not very tax efficient. So if you have a larger portfolio, there are better, different ways to be invested across that diversified portfolio. Okay, now, if no one's ever walked you through the funds in your plan, you're not sure what you own, what's it costing you, what they're supposed to be doing, why you might own one versus another, I believe that's a conversation worth having. I'm Darren Vilardo, the founder of Tekton Wealth Advisors, where we're best known for love, serve, and care for our clients so they can live their best life in retirement. And our commitment is always that we will serve you and not sell you. So we believe you should have an open and honest and transparent conversation about your funds, what you own, why you own it, and indeed, what does it cost? So reach out. Let's have a conversation. We'd love to chat with you. No cost, no obligation, and as always, no pressure. Okay, so next, what happens when you skip the stock picking or the bond picking entirely and just buy the whole market for a fraction of the cost? We're going to talk about what is an index fund when we reconvene for episode 20. Until that time, click that like button, bang the subscribe button. Let us know what your thoughts are on the comments below. And as always, we appreciate you and spending some time with us and our channel. Thank you so much. God bless.